The reason so many investors came to the US, foreign investors, was it was a safe haven of capital. If they lose confidence in the US, and we've had artificially lower rates because people have come in from around the world and said, hey, if I'm going to park money, I'm going to park it in the US. Well, currency is down. Maybe geopolitics and geoeconomics wants to drive down our currency. Well, who wants to invest from outside the country if you know the currency is falling? What do you have to earn on your investments to make up for the fact that we're pushing our currency value down? Okay, maybe that's not so great. Well, it's your marginal buyer that determines the price. And so if your marginal buyer says, hey, we got to get 5%, that's going to drive up the government market, and the rates are going to be higher. Well, that means that long-term cap rates on our buildings are going to have to increase.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, current events through a real estate lens. My guest today is a fascinating fellow. Sean Kelly-Rand is managing partner at RD Advisors, and he and I went through the global financial crisis of 2008 plus with very different experiences, but coming out of it with a depth of appreciation for what happens during a downturn that those who have not gone through the market simply cannot have, or have not gone through a similar kind of downturn cannot possibly have. So Sean is extremely interesting, and his business model today comes from or evolves from the lessons that he learned during the GFC and are very consistent with my own view of how to invest, not just in any market, but particularly in a market of such uncertainty as today. Now, if you would like a detailed analysis of our conversation and of other conversations that I'm having in this series, go ahead to GowerCrowd.com and subscribe to my newsletter, where I provide these analytics and more detailed insights in written format, as well as providing you with immediate access to the latest editions of the series. All there at GowerCrowd.com. Just hit the subscribe button when you get there. Okay, without further ado, this is a relatively long podcast. It is worth listening to every single minute of it. Let's get started. Sean Kelly-Rand, managing partner at RD Advisors. Here he is. Sean, I've been looking forward very much indeed to our conversation. We met on LinkedIn, and I think that you mentioned something about Lehman Brothers or something. That, of course, got my radar at full alert. So why don't you tell us a little bit? We'll get to RD Advisors shortly, but why don't you tell us a little bit about your background, your experience at Lehman Brothers, and what happened during the GFC, and what were the lessons learned during that time that inform your investment decisions today? It's a fairly big question.
It's a big question. Like, where do we start? How do we not get in trouble?
Well, let's start with the story. The story would be interesting.
Yeah, the story's good. I mean, my background, kind of starting well before Lehman and kind of, where we are, RD Advisors today, is I grew up in Boston. I grew up in kind of, what I'd call the hood, Puerto Rican, Dominican neighborhood, one of the only, white families there. My dad was a carpenter. My mom was, sold real estate, and she actually sold Fannie Mae foreclosures in the 90s. So I grew up in and around, essentially foreclosed properties, and my dad being a carpenter. So I thought, at some point in time, my career was destined to be buying foreclosed homes, fixing them up, renting them out. And that's what I was going to do. And then ended up going, doing well on my exams and going on to college and entering the world of kind of finance as a way of getting into real estate, which what I thought was always going to be my roots. And then I didn't realize I was going to end up I ended up going back to Columbia Business School. Before I went back to Columbia Business School, I spent, about 6 months in Europe, predominantly Madrid. Decided I want to live in Europe, and said, forget it. And I had done an internship at Lehman Brothers while I was in undergraduate at Boston University. And I'd worked in the economics department there, loved Lehman Brothers, loved the culture, loved the team, got along great with them. And so when I went back to business school, I wanted to work in real estate. I wanted to do investment banking or financing. And I said, hey, I want to go to Lehman Brothers. They were the top bond shop, which means if you're in the bond shop, my view is the debt markets rule the real estate markets, right? So, everybody is interested in the Goldman Sachs of the world, but really it's the Lehman Brothers, the debt side, the CMBS market, the financing side that really drives the real estate investment side, right? It's the kind of, from anywhere the 60% of the capital stack to really, the 90% of the capital stack, depending what year you're in, right? And who you are. And so it was very important to me to be kind of with the best bond shop, which Lehman was, right? It was clear Lehman was the top bond shop, which made them pretty much the top real estate group on Wall Street. And I wanted to be in London. And so, I kind of recruited, I had a bunch of different offers to, where I was going to go out of business school for my internship, which was then going to lead to a full-time offer. I got offered, Goldman offered to fly me to London. And, I had to get on the phone with Goldman and explain to them that I wasn't going to fly over, they were paying for my flight, business class, fly over to London to meet with them kind of as the sell week. And I said, sorry, I'm not interested. I'm going to Lehman. They're like, what? Oh my God, how could you choose this? It's like, no, but like, this is where, I got along with the culture. So that's kind of how I ended up at Lehman was, it was where I wanted to be. And, for me at the time, it was the perfect place. And this is 2006 to give you an idea of the market, right? This is 06 going to Lehman. And I knew then, I had, kind of give it context. So I graduated, it was kind of 04 to kind of 06 in business school. I had bought a house, and during my summer, basically, once I started at Lehman Brothers, I had sold my 3-unit property. I said, oh, we're at the top of the market. Like I could just feel it, and in the US, it was a 3-unit building. And I remember dropping the price and telling the broker, drop the price. It was 2006, kind of what I said, Filene's basement style. And anybody who knows, Boston, they had a, Filene's basement used to drop their price, I don't know, by a certain percentage every 2 weeks that it didn't sell. And so that was go Filene's basement. Every week it doesn't sell, just drop the price. Just bam, 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 buy $10,000 per week till we hit it, meet the market where the market's at, and get it off the books and move it, and I bought it in 01 and it had already run up so much that it didn't really matter. But that was kind of foreboding for, what was happening at Lehman Brothers and the firm. And, kind of 06, you've got this crazy period where there's massive amounts of, very similar for people who haven't been around that long to what happened in the run up in, after the pandemic, right? Where there's a huge amount of capital available in the market to close transactions, which is causing people to do deals that maybe they shouldn't have. And so while I was at Lehman Brothers, we had, we were being pushed as a team, and, I was an associate, I wasn't running the group, to do more and more deals because our cost of capital was fairly low. So, how was Lehman Brothers funded? Well, a lot of people don't think about this. You're in a real estate, you're in a bank, you're in a group, and you're saying, go do these deals. You don't think, well, where's the money coming from to do these loans? And, you talk about lessons, and we can get into this, but that wasn't my side of the business, was where the money was coming from, right? I was on the asset side. I was on the side that was going out and, either making the loans on behalf of it, or I was on the bridge equity side where we would effectively make the loans and provide the equity and then syndicate the equity. Kind of many as syndicators do, but, our partners on things like that might be like Tishman Speyer or, larger groups. And so, what was interesting, and kind of when you talk about it all, kind of like what happened in the end is, well, there was great assets. Lehman Brothers on the top core product. Offices, a lot of it was, today that's a dirty word, but even after, the GFC, offices were still in demand, right? Now we have a sea change in things. But one of the things coming out of it that I think people don't realize and don't think about, and I think about it more, big lessons learned is, what is the capital structure behind it? What about your asset and liability matching? And so if you're going to be making loans that are 5-year loans or 7-year loans, even if you're planning to sell them as securitization, but your financing capital structure on your own balance sheet is short-term, lending, which is very cheap, but is short-term. what happens to that short-term lending is, well, people can pull the financing. And, that's really what happened with Lehman Brothers more than anything else, was a crisis of confidence. If you go back and look at the actual assets that Lehman had, I believe, I don't know, somebody can verify this, was all the assets that the creditors recovered all of their capital in due course and time. The assets weren't liquid, but they were solid values. And I think the problem was, it was a crisis of confidence, and the capitalization of Lehman Brothers as a bank, it was poorly capitalized. It was primarily short-term debt, right? Like, somebody else coming out of it, commented, goes, well, if I thought about it as us being 99.5% levered on short-term senior debt, probably would have run the business a little bit differently. And I think that's the kind of the attitude today that I take, is going, hey, how do we run our business? We definitely think about, our lending side of the business. We want to keep our loans short-term. We're primarily, equity capitalized. We keep very low leverage. So our PPM has a strictly below, 55% recourse leverage to the fund, right? Those type of things in mind, going, well, how do we survive through the storm? Like, what was the key components of surviving through the storm? Is having the durability and the capital structure, which is a primarily equity-based capital structure, to ride through a storm. What do you want to make sure? What things do well in, come in the GFC? What didn't do well? Well, the senior debt is senior debt, right? At the end of the day, you're still going to collect, regardless of the value of the asset, you're still in first position. Mm-hmm. Your equity and your mezz, you're not in first position. And so you may have a great asset, but if you don't have the liquidity, you might get foreclosed on. So when we create our strategy, we created it with the idea that we were going to ride through the next GFC, and we were going to be senior debt. Right. So, our fund, RD Real Estate Debt Fund 2 is 100% senior debt, right? With that in mind, right? Riding through the crisis, you're going to do it in senior debt. Leverage, keep the back leverage low. Don't, 99%. There's some guys that are telling me out there saying, hey, we can get these awesome returns and we can, but it's leverage driven, right? And if it's leverage driven returns, it's not alpha. That's just leverage. And that has its, has a benefit on the upside and has its cost on the downside. And to me, the stability of just being able to deliver the same consistent returns quarter over quarter is more of a valuable target than being able to deliver outsized returns in one quarter.
All right, so let's talk about RD Advisors and get into the strategy and this little back and forth that you and I had on again on LinkedIn. This idea of equity, debt turning into equity, etc. We'll talk about that.
That was a funny comment. Just good comment.
So what did you learn after the fact about where the capital came from at Lehman Brothers? Let's kind of go to that level, right? So you were taking on this short-term debt and lending it long-term, and that's what kind of created the crisis. But where was it coming from? And the reason I asked that is I want to map that onto some thoughts about what's going on today. So where did that come from?
So Lehman Brothers is an investment bank and not a depository taking bank. And who knows if they had a small arm that took deposits in certain markets or whatever it is. But primarily, when you look at the structure, at least what we're doing is one of it is, when you're dealing with such a large institution, my division never saw where the capital was coming from, right? The capital was coming from, somewhere upon high, right? So you go and chat and, what is my cost of capital today? And it would be, at one point in time during, 2006, 2007, I was told my cost of capital was 47 bips over LIBOR. And so when you think about 47 basis points over LIBOR, it's an incredibly low cost of capital, right? You can basically do any transaction. God forbid I had that cost of capital today, right? But, Lehman was borrowing at very cheap rates.
From where? In hindsight, do you know, where was it coming from?
And I don't know exactly.
Was it coming from pension? Was it coming from foreign investors, sovereign wealth funds?
And I don't know. Quite honestly, I don't know. I'm sure I could go back and figure out and map it out. And
I see. Okay.
That. But the other bit you have to think about is, what did we do? So Lehman Brothers, at least our division, you have the lending business, which is primarily a CMBS business, right? So it's a securitization business. And so those type of loans are supposed to sit on the books for a couple of months, maybe 6 months at max, thrown in a securitization and sold off.
Okay.
And then you have to ask whether the bank is keeping a risk retention piece or not. But then you're living off of the strip interest, right? So you kind of get some of these fees up front, and you're making your money when you securitize it and sell it. So in the interim, right, really what, if you looked at how an investment bank or Lehman Brothers should have been structured for what they're doing is you do 5 billion of real estate loans, and then you quickly sell those off into the market. And then you recycle it and do 5 billion more, right? Or maybe you do 1 billion at a time. So you don't use tons of house capital, you use very little house capital. And what happens, I believe what happened at Lehman, and again, I'm not in C-section, is that balance sheet grew from that 5 billion, but then, in 05, 06, 07, we started taking on more and more deals. And so originally, maybe you take 5 billion and you securitize it, you sell it off. Well, behind that, you've got to have your next 5 billion coming in. Well, if your first 5 billion doesn't securitize because it's just a timing thing, and you add 5 billion more, and then you say, oh man, the market has demand for this, I'm actually going to do 10 billion. And all of a sudden you start building up, and then you've got a $36 billion real estate balance sheet. Well, what happens? Well, you had a great capitalization for 5 billion, but then you've got this extra, 31 billion on top of that, where you just borrowed short term because the cash was available. And then what happened was Lehman was earning so much on holding this balance sheet, right? So it was lending long for 5 years, let's say at a 5% rate, and then borrowing short term 99% at a 3% rate. And all of a sudden you get this huge margin increase. And so that margin on that money was feeding the rest of the bank, right? So there's a great article, and I think it was either Wall Street Journal or the New York Times, about how Lehman was addicted to real estate. It's a classic article. I think anybody should go back and read it, but it was basically that the real estate team was making so much money at Lehman Brothers that it was feeding effectively the growth of the rest of the bank. So Lehman Brothers wanted to not just be a bond shop, but really compete with Goldman Sachs and the others in this M&A business, the equity business, and others. Well, that takes a lot of investment. Where are you going to get that money to invest? Well, you've got this real estate business that's just, making loads of money. Take that money, feed the rest, and grow the best of the bank. And in theory, what happens is over time, you make enough money there that you diversify the business, you go in. Well, what really happened? Well, in 08, kind of 07, you got caught in the middle of the storm. And, you can't get out of it. Once you're there, you've got it on the balance sheet, and then you go and say, well, what happened with Lehman Brothers? Why didn't Lehman Brothers just sell the loans? This is the problem, and this is the problem when we talk about today's situation. You go, why don't the banks take a loss on some of these loans? They can afford to take a loss. Well, you can and you can't, right? So you've got 30 billion on your balance sheet, and we can talk about Lehman, but this could be any bank today in the US. And you say, oh shit, the market value for this loan that I did that was 100 million, really, because interest rates have fallen or interest rates have risen, the value of my loan that I did locked in for 5 years, even if the value of the property is the same, I did the loan at 5% and today's market rate is 7%. You've got a duration risk. The value has fallen 10, 20%. Crap. Well, if it's, if I'm going to, if I sell that one, I have to reprice, it's only 100 million, but I have to reprice that other 30 billion on my balance sheet.
Right.
I can't sell it. I can't sell it. And
mark
so
to market, right?
If I have to mark to market, if I sell one, I have to mark to market the rest. Boom, your value is gone. You're bankrupt the next day. So you're sitting on all these loans and you can't sell them because you can't sell at a discount. And so if you can't sell today at a 10% discount because that'll make you bankrupt, well, tomorrow that it'll be a 15% discount, but you can't sell today because it's an immediate bankruptcy. So what do you have to do? You have to hold it through the storm. You have to hold on and, think of what's the movie, Forrest Gump. Just hold on to the mast and ride it through the storm. And so if you can make it to the other side of the storm, you're golden, right? You're golden. Make it to the other side of the storm. And so that's what Lehman Brothers was trying to do in essence was, shit, I can't sell these today because I have to take a mark to market. That'll bring the whole bank down. And eventually that's what brought the whole bank down. It's kind of, they announced that they were going to separate the bank into a good bank and a bad bank. People said, hey, that math doesn't work. Next day, it kind of collapses, right? Crisis of confidence. The funds got pulled out. And it was, it was kind of over. And it took a slow decline, but that's what, it happened very suddenly. And I think, today, the scary part to me, as we get into it, is I don't think it's that different, right? I think we have a real issue on the banks. And I don't think people are paying close attention to this. And people go, well, hey, the residential values are still up. The multifamilies are up. The office, maybe that's not just a big exposure to the bank, and the defaults aren't that high. Yes, but the banks did a whole bunch of loans at 3%.
Mm-hmm.
If you replicated that deal today, it's at a 6% rate or higher, maybe even 7%. There's a mark-to-market value of that loan. Mm-hmm. The mark-to-market value of that loan might be 20% less. Okay, so you're earning 3%, you're borrowing at a higher rate than 3%, right? So, if any individual goes and looks at their mortgage and you go, hey, I did a mortgage with this bank. Wait, I borrowed from 3%. My loan is still on the bank's balance sheet and they're paying me 4.5% in deposits. Well, how are they making any money? How
does that work? Right.
But then I start getting scared going, wait a second, how do they continue to pay me 4.5% deposits if they're only earning 3%? And I can't be the only one with a 3% mortgage. And not a lot of people are refinancing their 3% mortgages into 6% mortgages. Wait a second. Houston, I think we have a problem. And I don't think the wider public has caught up in that. And now you go and say, well, shit, if that's the case, make sure you're under the 250 limit in any one bank account, right? Because it's kind of scary. And you've got this, situation where now you have a bunch of banks that are paying out to depositors more than they're earning on their mortgages. And I think what's saving the banks today is, and these are the deposit-taking banks, is a lot of depositors, myself including, have not gone through every single account and gone, hey, wait a second, I was earning 1% on that account. Like, no, I should be earning 4%. But if everybody individual, and maybe you've got 10,000 in an account or you've got 20,000 there, you're not paying attention, right? It's not that big. But it adds up, especially for these larger banks. And I think if everybody goes back and says, hey, wait a second, I know it's small dollars, but I really should be earning 4.5% on these accounts, then you're going to be in a very different situation with the banks. I also think,
Yeah, go ahead. Yeah, continue.
I also think that they haven't recognized a lot of their losses. And I think, they've got office buildings all over that aren't worth what their loans are, right? They've got a not an LTV, they've got a VTL, right? The buildings are a 50% VTL. They're 50%. The loan is 100 million. The building is now 50 million. It's a 50% value to loan. But if it's still paying, interest, or they can claim that it's a rehab loan, or there's a renovation, or they're converting it to resi, or they're converting it to lab, or something else, they don't have to recognize a loss, and we'll carry that through. Ride it through the storm. If I can get through the storm and recognize the loss later, I'm fine, but I got to ride it through the storm.
Right. This idea of extend and pretend. So, there were a lot of regulations, as you know, that were put in place, particularly for the banking system after the global financial crisis. And one of them was to elevate the amount of tier one capital equity that every bank has to 5%. Basically a backstop, right? To secure banks against exactly these kinds of problems. The current administration is looking to deregulate some of these backstops. How does that make you feel, having gone through the GFC, about the health of the financial system as we go forwards?
Yeah, it doesn't matter till it does, right? It's very easy to say, hey, these things, everybody's fine. Everybody's fine till they're not. That's the problem, right? You get to say, and you know what? It may be just fine for, vast majority of banks out there, right? But there's quite a few banks that's probably not okay for, right? And then when you go and you look and you say, especially for the larger banks, that's a systematic risk, right? And I think they should be required, right? If you're going to be the largest banks and you're going to be a depository and you're going to be, and maybe in some sense, it really comes down, what I think the administration would say, or people would say is, hey, people should self-regulate, right? People are going to know which banks are more solid and which have capital, right? And banks are going to start advertising, right? Where are you going to keep your deposits? Well, the FDIC. So, the FDIC shouldn't meet these things, because at the end of the day, the FDIC is responsible for insuring these. As a larger, depositor, you really need to go back and evaluate a bank balance sheet. Like, to be quite honest, even with my knowledge of banking, and I'm no longer a banking expert, right? I left the, kind of the bank market, don't deal with the bank market. I'm a private, I manage a, a private credit fund. I can't go through and analyze a bank balance sheet. I have no idea what's in there. No idea. You can read through it. You can go through it. You can go through the notes. Nobody knows what's on a bank balance sheet. Nobody has a clue, right? Like that's one of the clear things that came out of the global financial crisis last time is, guess what? You can put in rules. The banks are going to figure, there are some really, really smart investment bankers. They're going to figure out exactly how you get around this tier one capital rules, all these sort of things. We're going to trade things intra-quarter. At the end of the quarter, your year end is different than my year end. The test is this. We're going to transfer assets back and forth. I'm going to, if it has this designation, it falls into this box. If it has this designation, it falls into this box. We're going to play on the system. I kind of feel all that stuff is going to happen regardless of these rules are in place, but certainly I don't know if I want to make the banks less safe at this period of time.
Right, exactly right now. So what are there any echoes that you see in today's environment from the global financial crisis?
I mean, which ones do I see? I mean, blaring, blinking light, affordability. Right? Affordability has gotten to a point where it doesn't really make sense for people to buy. This is the residential market, but also the commercial market. The yields are flipped, right? And you've got to count today's prices are higher pretty much than they were when rates are 2%. You go, well, wait a second. If your average consumer is borrowing at 6% and prices were higher than they were at 2%, well, have incomes and rents gone up that much? No. So how's the math work? And then when you go and look at yields, they're all inverted. So I guess we're in a world where everybody's counting on rates coming back down to 2%, 3%, 4%. I don't know. I don't see that happening, right? So I think there's, I think everybody's waiting on the massive, Fed put and kind of a bailout in the real estate market, right? In terms of values. I don't see that coming, right? I could be wrong, but it's not my job to predict it, right? My job is to protect the downside, but I feel that I think it's an unlikely scenario that the Fed comes in and says, "Hey, we're dropping rates." And even if they do, they're dropping short-term rates. Do they control the long-term rates? Probably not, right? They don't control it, and I think those are a lot of external factors. So things today, I definitely have seen, and again, I think we're cooling off a little bit now, right? Like I think we're past peak. I certainly would feel it. But
past
if
peak
you want
what? Past peak what?
Values. So I think residential values, really, I think we're going to see this spring. So, split into the residential market and the commercial market, right? The commercial market has occupational, issues with occupation, right? So we'll talk about, occupancy essentially, not occupation, but occupancy. So if you look at, your office buildings, right? It's a sea change, right? That's not about cap rates. That's about, do people want to be back in the office, back downtown? And so if people don't, well, then what's the value? Because it's valued off the rents. And so if rents are down, 30%, well, then the value of the building, given the expenses probably have increased, might be, it's not zero, but depends on the market, right? That's a particular to the office market, right? And then we can ask, are people coming back to the office? Maybe, but how quickly? So that's one issue that's on the bank. And so I think the opposite is, I don't think they're overvalued. I think the ones that are selling at fair market values. The residential side, and this is the homeowner market, I think people are still, paying based on what the neighbors paid for their house, but aren't taking into account that their neighbor bought it when it was 2.5%, and today's rates are, 6%. And so, affordability is the issue, right? And then what you're seeing now is, if you look at, this isn't, we're based in Boston. I think Boston has its own market. I mean, it has a supply issue, right? There's hardly any supply. There's very few homes in the market. There's, it's very hard to build here. So that holds up values a little bit better in my view. But if you go look at the high supply markets, so the Texases and the Floridas, supply is building up. And this is inventory. So inventory is building up. What happens when inventory builds up? Well, customers have more choice. They can be pickier. They tend to wait and feel like, hey, maybe I can get a better deal. And there's no rush to buy because it seems like every single month there's more offered. Well, what does that normally mean? Well, normally when you have massive amounts of inventory building up, some guy in that massive amount of inventory has to start cutting his price and sell now. And when that price starts selling now, and that guy says, hey, it's Filene's basement time, I'm going to start cutting my price every week till it sells, it kind of forces the market to follow. And I think we're probably getting to the point where I expect, prices are already starting to come down in, kind of the Texas, some of the Texas markets, some of the Florida markets. Does the dam break and do values really start tumbling? Don't know. I do know that capital providers, a number of capital providers have kind of pulled out and said, hey, this is kind of rumors on the market, right? This isn't, nobody said it like officially and kind of putting it out in the press, but, behind the scenes, a number of capital providers have said, hey, maybe we don't want to be as much in Florida and Texas as we were before, right? And so those capital providers are pulling back, and this is on the real estate space. Because they view it as somewhat risky and a market that maybe is about to burst. I don't know if that holds true to maybe the Arizonas, but think about, these pandemic boom towns, they might not be doing as well now. The Northeast, if you look at the numbers, has held up fairly well because it's hard to build in the Northeast. Prices didn't run away as much, didn't run away, but I expect prices will moderate here as well. And I don't think it's a bad thing. I think it's a good thing, right?
So let me move to RD Advisors. So you left Lehman Brothers, or it left you. And,
yeah, Lehman Brothers left me. Wasn't my choice.
Right. So
wasn't my doing. It wasn't my choice.
Okay. So, but you carried with you some insights and some lessons from that experience in a different way than I did going through the GFC. We both went into it differently, came out of it differently. But you then set up RD Advisors. So what was the investment thesis and why did you adopt it? Again, in the context of your experience going through.
Yeah. I mean, in a couple of things, I'll do a segue between that. I've been running RD Advisors for about 8 years now.
Okay.
Before doing that, right after Lehman Brothers, I did debt restructuring for a year, advising a number of companies, including Morgan Stanley, Goldman Sachs, and a few others on essentially restructuring, recapitalizing deals coming out of the GFC. And then I went and ran, opened the London office and ran the London office for Madison International. So that's now like probably about a $4 billion business. And so that was, sourcing and, effectively acquiring and recapitalizing deals across Europe and the US. And then I came back, and while I was doing that, I started buying properties in the greater Boston area. And so during the great financial crisis, so starting in 2010, I started buying, 3 to 12 unit buildings in the greater Boston area, so multifamily, but, on a fraction of what they were selling for in 2006. So we're essentially buying things, at the depth of the market. I did that primarily with my own capital, but with some friends and family as well, one of which is Dominion Capital, which is, the family office. Dominion Capital. There's a lot of Dominion Capitals out there that came in and backed us on buying a number of these properties. That later, there's a couple jobs back in the US, but 8 years ago, we kind of sat down and we'd been friends for a while and said, hey, what do we want to do with our own capital? And, this is in 2017. And we really said, hey, look, we'd like to build something together. They wanted to stop doing passive investments and really be more active providers of capital. They wanted to partner up with me because I had this kind of institutional track record or institutional experience. They said, hey, we can provide some capital to this. This helps us get smarter what we're doing. Why don't we partner up and do something together, right? We can use our back office as a family office. We can use our capital. We can get something started. You're bringing in a lot of this expertise, especially coming out of Lehman Brothers and, Madison International. Let's start kind of essentially a third-party fund business, starting initially with our own capital. So for our first 4 years, it was pretty much my own capital and their capital. Mm-hmm. And when we
doing what?
Doing senior lending.
Okay.
Initially we start up and we said, well, what are we going to do with the capital, right? And so are we going to be a private equity shop where we're going to go out and buy buildings? We said, we're 10 years out from Lehman Brothers, right? 10 years out, cycles tend to be in 10 years. Maybe it's not the idea time to go into equity, right? Where do we want to be? We don't know when the next recession is going to hit. We don't know. It's a black swan, right? It's going to happen and you don't get time to prepare for it. Right. So what do you want to do knowing that you don't know when the next recession is going to be? Well, you want to be in the most defensive position. Where's the most defensive position? Well, senior debt. Okay, senior debt, what type of senior debt? Well, short-term lending, because then your loans are recycling fairly quickly. You don't have the duration risk, so you're not stuck with making a loan 1 year and then 5 years later getting your money back in a completely different environment. You're doing it kind of 1 year to 18 months, maybe 2-year max loans. So you're fairly close to origination and exit. You have a much higher yield on these. So, we're typically lending anywhere from, probably our lowest rates on our loans were around 9% when, Fed funds rate were close to zero. And, today they're around 12%, right? Short-term bridge lending. And what markets do you want to do it in? Well, hey, gee, real estate in Boston. You went to school in Boston. You own assets in Boston. You grew up in Boston. You know a whole bunch of developers in Boston. You have crews in Boston. You own your family owns a property management company in Boston. Gee, and guess what? It's a non-judicial market. The average home price is pretty high. The economy is pretty diverse. Heck, that seems like a pretty good market to be in. And, we've kind of, now the hard part about Boston is it's a harder market to get into and originate. So there's not a lot of competition from external players because it's very hard to enter. It's a very parochial market. Kind of like a close-knit market. But hey, I happen to be from here and own a bunch of assets here and already be here. So it made sense to be, to do our lending in the greater Boston market, which we think is one of the best markets across the US. Just, same thing, great economy, non-judicial market, and, fairly average home prices and very little supply.
Okay, non-judicial meaning?
That you don't have to sit in front of a judge in order to do a foreclosure. So a foreclosure process, it takes us about, I would say anywhere from 30 days to 60 days to kind of get started. The same process in New York could be a year to kind of 3 years. Yeah. New Jersey, same thing, right? Florida, judicial market, right? It's going to take you a long time to go there. Well, crap. Really don't want to be a lender in a market with a whole bunch of oversupply and a long time to foreclose. Maybe don't do much there, right?
So let's talk about this idea that you and I tossed around a little bit. It was kind of cool. I actually really did think that this must have been your thinking when you set up the debt platform that you have now, first position loan platform, was that it's private credit. In other words, you're lending debt or you're offering debt, private credit. In a downturn becomes private equity at a discount. I actually thought that must be part of what you were thinking when you did it. Come through. But just explain that concept. And I know it's not the core strategy, but just walk through that.
But I do think it's a very interesting point, and it's funny. I find it so funny that you'll have people that are heavily invested in the equity markets. They'll invest in a real estate deal and levered up. They'll be part of it. And they'll go, oh, private credit. I don't want to do that. That sounds risky. Well, and I don't know about what loans you're doing, short-term in nature. They have some construction involved. And I go, no. So you're in the equity markets.
Right.
You're on the equity side of real estate, and you're worried about the market. So let me understand this correct. You're on the equity side. You're worried about the market. And because of that, you don't want to invest in the debt. Mind you, I might own the equity when the market downturns, right? And so,
how does that work? Just explain that, because it's a concept that you and I understand intuitively. We know what that means, but just describe, how does private credit become private equity at a discount?
So you go, somebody puts
give us an actual example of something, like a.
Well,
but not a real example, but I mean
we go, somebody's buying a building. In Boston, it's a rental property, and they buy it for $1 million. They put down $300,000, and we lend about 70% on it. So, that's $700,000. Well, the market turns. They don't execute their business plan. They have no exit. They stop paying on our loan. Well, any of the investors in that $300,000 of equity, which has said, hey, it's multifamily, it's safe, don't worry about it, it's fine, it's going to be cash flowing. Well, it's fine, except you can't pay the mortgage. Something happened. We go through a foreclosure process. We auction it off. If we're the highest credit bidder at the auction, we end up with the asset. Our original loan was $700,000. That's all we've ever put out. Maybe interest is built up. and we'll go to the auction, and either somebody will bid. Let's say our interest rate is 10% for easy math. Mm-hmm. And let's say there's a default of another 10%. So it's grown by, they stop paying. They owe us, kind of, 70,000 for regular interest because it took a year to go through auction, bankruptcy, all that stuff. Another 10% for, the default. So now you're at 140,000. So original basis is 700,000 that we've lent at. And now there's, 840 is what we're actually due. We go to auction and the highest bidder is, 800,000. We decide not to take the 800,000 bid because we're owed 840,000. We credit bid 840,000. And for an asset that somebody else bought, for $1 million and put $300,000 in there, we own for 840,000. Right. So, at, essentially 84 cents on the dollar. And all during that time, right? Essentially for 700,000 and a year's wait, you own this asset, right?
Now you own the asset.
You can either see it as a, 14% discount to there because we're owed some money for it, or you can see it as a 30% discount given the basis, and you take over the asset, and now we own it, and then we refinance it for $500,000 on it, and we've got a great cash flowing asset at a discount.
So how do you underwrite? So now explain the business of RD Advisors. What is your core business? And with this, debt to equity kind of thing in mind, which I really did think, I saw so many people look, I sold billions of dollars of notes, of non-performing loans. That's what I did. The bank did not want to foreclose. They just wanted to get rid of these notes. It was a whole, there was a falling sword environment at some point, you never knew. But, and that's what people did, was they bought the loan with the express intention of getting to the real estate. That was what they were doing. And so I figured that must have formed part of your calculus. But
no, the idea that we can take over is definitely part of the calculus, right? And so, when we do so our underwriting, at its core, right? There's a whole bunch of different components, and I underwrite closer to a bank's underwriting in terms of doing a full underwriting, background, credit, underwriting the asset, underwriting the cash flows, underwriting the sales, underwriting the pro forma, right? Because that's my background. Far more institutional underwrite than your typical private lender in our space.
Okay.
But the core of it is essentially what you talked about is, and we always shout at our team and trying to figure out what do we lend on it, right? Today we typically say, and when I instruct my team and we have our metrics, we'll lend about 65% of, if it's a renovation, about 65% of what we believe the value will be after the renovation, because there's construction proceeds, right? So, it's a 65% after renovated value, right? So a 35% discount to where we believe that the value will be sold, the asset will be sold at. So that's our fundamental metric, right? Because you can get the borrower right, you can get the experience right, they can have great credit, shit happens, right? And you can't control all those environmental things. They could be a really good developer developing 3 assets, and that asset, that fourth asset that you happen to be a lender on, they just don't execute on their business plan. So you have to be fundamentally comfortable with owning the asset if you're going to be a lender. That's why banks, in some sense, make shitty lenders. They're cheap capital, but they're underwriting that the borrower won't default because they can't own the asset. We don't want to own the asset. That's not my business plan. My business plan is, lend to bankable borrowers or non-bankable situations. And that's mainly speed. Most of our borrowers come to us, they're able to get bank financing, but this situation is one where it's just easier to get, the loan balance is small enough that it doesn't really make a difference between where the bank rate is and our rate is, right? Because the timeline is so short. What they need is speed of execution. Or it could be something like, in Boston today, the office to resi conversions. We've lent on a few of those, and the banks don't want to lend on the office building, even though it's an as of right resi conversion. We don't really care. We know it is. If we take it over, we'll just go through the process ourselves, or we'll sell it off to one of the 100 developers that we deal with that will go through it. So, but the fundamental, as you say, is what is my discount today, my loan basis? What is the discount to that asset value in the market today, or what we will believe it will be in the future, right? We may take a view and go, you know what, I know it's worth $1 million today, but I think we're in a declining market. And I think tomorrow that asset's going to be worth 900,000. Well, I better do my 65, 70% value off the 900,000 on exit. You still may want to do the loan. You may still say, hey, the sponsor has a good reason to do it, right? They want to stay in the business, even though they know that the value is declining, but they're going to take us out with a refi. It's a long-term asset. They don't really care about, the volatility in the market. This is a long-term play for them, and that's great, but that's not my play.
But you're still gonna lend. You're just gonna lend less than you would.
Lend less.
Yeah. So do you see a downturn coming? I actually wrote this question for you. Any GFC PTSD?
Yeah, every day, but every day, we laughed about, I spoke at Super Return, and we did an interview during the Super Return, and I was on the panel, and everybody's asking about, do you see recession coming? It's a question that everybody's asking in this environment today. And I said, yes, every single day since, 2017, I've underwritten as if a recession is coming. So nobody believes me anymore when I say, hey, I think a recession is coming. They said, well, you've been saying that from 2017, and it will happen, right? The question is, what day will it happen? When will it start? Are we already in a recession? And I think that PSD is really around, it's almost my first job out of college was at Intel, right? And Andy Grove writing the book, Only the Paranoid Survive. And so, it's kind of a harsh way to think about it, but every single day, you kind of have to be a little bit paranoid when you're doing underwriting and you're a lender or you're doing
So the reason that I ask that is, if that is the case, right? And you've been saying that for many years, but the world has changed just in the last few months. Fundamentally, there is a fundamental shift in what's going on in the world. And I'd love to understand any of the aspects kind of on a geopolitical, geoeconomic, a new term I've been learning recently, geoeconomic level. That brings the possibility of a downturn being more imminent than at any time since 2017?
Well, the current geoeconomic politics is this like tariffs on, tariffs off, no deal, rates. I think the uncertainty around that,
Right.
You'd speak to global investors, right? And so, our investor base primarily is high net worth investors, right? So we're not speaking to the institutions, but if you go out into those high net worth investors and you look at where they're, even you speak to some of the institutions, the private credit funds we might partner up with on individual transactions, their view is kind of, let's take a break, right? Like, what I don't want to do is catch a proverbial falling knife. Mm-hmm. I want to take a cool off. Like, I don't want to buy assets, right? And I just had an investor, who is on another, not an investor in our fund, but somebody who's buying assets say, hey, we were buying an asset in Boston and one of our investors just pulled funds at the last minute because of the geopolitics. They just said, hey, you know what? We're taking a pause on all new investments. So I think a lot of the investors, in the US, not just globally, are saying, hey, wait a second. I want to take a step back, right? I want to take a step back before I do my next equity investment, before I do my next allocation. And I kind of want to see where this thing's all settles, right? There's all this dust in the air. The storm is going. Let's take a break, right? And so we don't know if there's a recession, but we know that the winds are changing. And you know what? Let's just wait till after this kind of storm settles before we start putting. And that in itself may cause a recession, right? Because everybody says, hey, you know what? We're not going to do that investment on that. We're not going to start this project. Well, that's jobs. That's CapEx. That's effectively money that's going back into the economy. And everybody's going, let's put a pause on it because I don't know where the world is going. And there's so much uncertainty. So the uncertainty, more than even the tariffs, I think is going to drive potentially a downturn, right? Because we will pull back and say, I'm going to hold off on that home purchase, right? I don't know if my job is safe anymore, right? So therefore, I'm not going to make that big purchase. I'm not going to make that big investment. I'm not going to start this company. And so I think that could drive a little bit of uncertainty and turbulence in the economy. And we're seeing that. I think on the flip side, one of the things we're seeing is private credit, kind of the institutions. And now I think some of the individual investors have figured out, if I'm going to wait out a storm, where am I going to put my cash? Am I put it all in the banks? Well, maybe the banks aren't the safest place to put my money because they're, levered as they are levered, and who knows what's on their books. Am I going to put it in the equity markets? That's highly volatile. And like, we've already seen this volatility. I'm going to pull my money out of the equity markets. Well, where could I put it? And they're like, hey, there's this thing called private credit. It seems to deliver these steady returns. And it's not what I was getting in my equity returns, but my equity returns now we're down and then up and then down. And then like, I don't want to stomach that volatility because it might go down again. If I can get this, relatively higher yield in what I feel is a capital protected position, then maybe I want to allocate more to private credit. So actually what I'm seeing a little bit of now is there's actually more going into the lending space than before. And there is actually some downward pressure on rates and some upward pressure on LTVs. I don't think it's a great thing. And I think some of the investors that have jumped into the market, are in and out players, right? They don't really understand it. They just think, oh, it's a better place in the capital position, but they're not necessarily getting the best transactions. So I think there's a little pressure there. And I think that's going to have some bad outcomes. I don't think it's going to have bad outcomes for the market as a whole. I think it's going to have bad outcomes for those that jump in without really knowing what they're doing, just because they have the funds to do it. So, that's one thing that I see there. But I do worry long term. I think the big worry that people are forgetting is foreign investors, if they lose confidence in the US,
right?
If they all of a sudden say, and we've seen this in the UK, you can go look at the UK after Brexit, right? Look at the housing market there. If all of a sudden, in Boston or wherever it is, or Florida, the reason so many investors came to the US was it was a safe haven of capital. And we've had artificially lower rates, right? So we've had artificially lower rates and higher prices for housing. Why? Because people have come in from around the world and said, hey, if I'm going to park money, I'm going to park it in the US because it's a safe place, a stable economic environment, a stable rate environment, and the currency is pretty strong and stable. Well, currency is down. Maybe geopolitics and geoeconomics wants to drive down our currency. Well, who wants to invest from outside the country if the currency is falling? What do you have to earn on your investments to make up for the fact that we're pushing our currency value down? Okay, maybe that's not so great, right?
Well, the flip side of that also, and this is, I'm so glad that we got onto this. I wasn't sure if this was something we were going to talk about, but this is something I've been studying a lot recently. The trade deficit is actually what sends all our dollars overseas, and that's what brings them back, right? There's all these foreign, right? Everyone has to, now you've got all these dollars, where are you going to invest them? Are you invest them in treasuries or real estate or wherever it is? And that is what's it called? I keep forgetting. Not something privileged. Why do I keep forgetting? It's not obscene privilege, but
well, it's a benefit of being a global hedge.
Well, it's the idea that we've been able to lend at incredibly low rates despite running up in this huge deficit.
And so, and so then the question is, well, the big worry, forget it's government, right? So then you go and say, well, if the Chinese and the Japanese and everyone else don't want to buy our marginal, and you can say, hey, they're 10%, 20% of the market, so it doesn't matter. Well, it's your marginal buyer that determines the price. And so if your marginal buyer for 10%, and you need more buyers, right? Because you have more debt each year, says, hey, we don't really like it at 3% or 4%. We got to get 5%. That's going to drive up the government market. What's going to happen? Who's buying the mortgage market, right? You don't think that's all American banks that are buying that. And by the way, if the mortgage, if the treasury, if you can buy government debt at 5 or 4, what are you going to be paying for mortgage debt, right? You're not going to pay less. You're going to, the rates are going to be higher. So, demand a higher rate on it. And so then you got to look and go, the individual consumer goes, wait a second. Are you saying that for the past 30 years, I've had artificially low mortgage rates, artificially in the sense that it's been subsidized by the government and subsidized by, all these, foreign buyers of our mortgage and our treasuries that then drive down US cost of capital. Well, wait a second, if that unwinds and the US cost of capital increases, and so our long-term borrowing rates increase, well, that means that long-term cap rates on our buildings are going to have to increase.
Yep.
Oh man, that's not so great. And
Yeah.
so, that's where you have the real worries about the long-term nature of it is, yes, if you're fully dollar denominated on one hand, what do you care about the currency? But long-term rates might be driven more by what other people from outside the country are willing to pay than people inside.
Exactly.
And then, by the way, US dollars might say, well, shit, I might want to get some money out. I didn't need to diversify before to Europe because Europe wasn't doing well. Well, Europe is now saying, shit, we got to kick off our economy. And what happens if US dollars start going and the euro strengthens versus the dollar? And you see, well, not only do I get the benefit of being in economy that's kind of catching up and growing up. And by the way, their stock market isn't trading at such, high PE ratios, right? They may be more sensible, higher yield on that. And the currency might strengthen relative to the dollar because we're intentionally weakening our currency. That's not really great from a capital flows, right? Like that's not my expertise, right? Like
no,
those are my subtle thoughts.
You're speaking very, very sensibly, and I don't mean to patronize about that. It's exactly the point I'm getting at. And the term that I momentarily forgot was exorbitant privilege. It's called exorbitant privilege. And I think it was the French actually named it after World War II. But anyway, it's a whole different story. But here's this question. I've got a question. So we talked about this idea of private credit becoming private equity at a discount. Let me now extend that a little bit, because I know that's not your strategy. But having lived through the GFC, the idea that liquidity is stalling because of uncertainty. It's uncertainty. It's not because people aren't sure if the market is going to be amazingly good. It's because they're unsure if it's going to crash, right? That's what people are uncertain. If people were, well, we're not sure how great it's going to be, everyone would invest. The concern is people are that it's going to actually go the exact opposite way. Therefore, for a shop like yours, that is lending debt, why don't you, he said, proposing the idea, gear into that or lean into that? Because people want to make money, right? People have all those people sitting on cash. They're not sure, they're uncertain. If their concern is that there's going to be a downturn, lean into that and say, hey, we've got the perfect instrument for you. Don't wait for assets to default and then buy the notes or buy the REO or buy them. Invest in them now, get some solid yield while you can on the debt side. And if you're right and there is a downturn, you'll convert that into equity at a discount. Why not do that? That's actually that's a suggestion, actually a direct. So I think that would play well, actually.
I think, and I think the reality is yes and no, right? So the reality is, one, lend as if you might own it, i.e., don't count on the borrower paying you back. Make sure you're at a leverage level that if you have to take it over, you're comfortable taking it over. Well, if you're at a leverage level where you're comfortable taking it over, it's probably because there's enough value there that the sponsor can get out.
Mm-hmm.
And so then you get into a business where, the vast majority of my business is repeat clients, right? So repeat clients and referrals, right? And we're cycling through these things fairly quickly. So will we take over a few assets? Probably. What will we do to them? We're a lender, right? And you think about how much time there is to work these assets out. We actually have made money on some of the assets that we've taken over. So it's not, I think we've taken over probably about 4% of the assets that we've ever lent on. Of those, we have not, yet taken a loss. Law of large numbers, we've done probably about 400 loans at some point in time. We're going to do 1,000 loans, and a certain portion of those, if they go bad at 4%, we'll take a small loss. And that's the idea, minimize your losses. But as a business plan overall, it's very hard to pick the best assets, do a great loan on it, hope the sponsor doesn't go into default, refinances it, and then yet have the asset that just magically, it's the best asset out there, lands back in your lap at a huge profit, right? What you end up with in a lot of these ones where if it's almost loan to own is, well, you're picking out the borrowers that you don't want, right? And they're letting go of the assets they don't want in a downturn, right? So the banks, Well, they were loaned to own unintentionally. Well, what do they own? They own a bunch of office buildings that are downtown and they don't want to own them, right? I think what happens is if you go through the auction process, if you've got a great asset, what's going to happen? Well, situation we described before. My loan was $700,000. The asset's worth $1 million. You got it right. It's still worth $1 million. Maybe it was worth $900,000. Even at 20% interest rate, right? My default interest rate. Well, it sells for $840,000.
Mm-hmm.
My investors get $140,000, so 20% interest rate in a year, without ever having to own the asset. Because of the default rate, you got a 20% return. That's probably even better than owning the asset, investing in it, working the asset, and then ending up with an asset that maybe you don't want. And I think it's a separate business plan in terms of what you run on your team. So if you go and look at the NPL buyers,
non-performing
Lone Star and Hudson Advisors, they set up a machine that goes through and owns and runs these assets. And at one point in time, and really for our investors, the problem with some of this returns when you take over the assets is you may end up at the same return in the long run, but it's a lot lumpier, right? And what my investors love about our strategy is, hey, what were the returns last year? Guess what? They're almost the same as they were this year, right? In our quarterly calls, if you've attended them, they get kind of boring. We have to do educational material because it's like, what were the returns this quarter? Well, guess what? They're almost the same as the returns that we've had for the last 8 years. It's like, well, how much volatility? Very little volatility. That's why people are investing. And so then when you start to do almost like a loan to own strategy, you add in this volatility because while you're taking over the asset, if that becomes, let's say today, non-performing loans or delinquencies, right? Not even non-performing loans, but just delinquencies, are probably, somewhere between 5 and, really, 6 and 12% of our book, right? At any one quarter, right? That's kind of around where they are. And I think that's like, if the industry was honest about where it was, I think that's what they would say it is. And so, and by the way, a whole bunch of the private credit industry isn't honest about it because they build in interest reserves and they do this accrued interest. So they just, no interest was due. So it never defaults, right? You always just say, well, you just pay interest, pay in kind at exit. Well, you can't ever default if there's no interest ever having to be paid till exit. Funny that. Good for the metrics, but bad for the investors, right? We're cash flow based, right? So people have to pay, every month, right? So that means that there's months that people don't pay. But that induce, kind of creates this lumpiness in the returns, right? That, it's just that 10%.
Well, it's also, I think the point that you're making also is that it's a different business. It's actually a different business. Taking over the properties is a different business. It's a different mindset. It's a different skill set. It's a different business. I was just thinking of a way of, levering open some of that capital that's sitting there because of uncertainty. Here's a place that you can go where
and you know what? We are good at it, right? We thought about it. At one point in time, I approached my partner and I said, hey, you know what? We're pretty good. I own assets in Boston. I've developed assets in Boston. We've taken over loans. Our loan docs are great. Our underwriting is great. We've got great lawyers. We've done it before. We've been at this for 8 years on the lending side and probably 20 years myself personally investing in the Boston market, right? Over 20 years, probably about 25 years since I bought my first property in the Massachusetts, right? And so, I think we can do this pretty well. We can do the NPL business, right? We understand the loan business. We understand the asset business. Why don't we start an NPL fund? Quick rules is you can never buy you can't smoke your own dope. You can't ever buy loans out of yourself. You got to work those out in your funds, right? You don't want any conflicts of interest, but we could buy other people's non-performing loans. We can buy bank non-performing loans. Why don't we get into the business? And my partner kind of said to me and said, hey, Sean, of our loan book, where do you spend all your time on the asset management? Well, of course, on those, 10% of loans that are delinquent. Okay. So you're saying that of the 100% of the time, 90% is spent on the 10% that are non-performing. Yes. And now you want a 100% non-performing book. Let me understand this correct. So you now want to spend all your time dealing with loans that are that you describe as pain in your ass, right? Like this is this really what you want? And, what does that else allow for, right? And then I think you think about it and you go, okay, what type of team do you have to build up to do this non-performing loan business?
Yeah. It's a different business. It's
And
all,
is the juice worth the squeeze, right? And you have to say, okay, and there's groups that do incredibly well at it, right?
oh, yeah.
And then you also have to think about this other perspective is Boston's a non-judicial market. That means that it takes 60 days to go to auction. What it means is, well, if somebody wants to send something to auction and it's easy to get to auction, they'll just send it to auction. If you're in New York, that's an ample non-performing loan market because it takes 3 years to get to the auction. And so banks don't want to sit around they're willing to sit around for 60 days, but they're not willing to sit around for 3 years.
Sometimes, and we should start to wrap up, actually. I mean, I'd love to continue talking, but actually, I can't believe, wow, I've been going a long time, and I've got some kind of sign-off questions. But my experience, I worked inside a bank. My job was to sell these non-performing loans. They're in a non-judicial state. There was no interest in taking over these things. And in some cases we had to, but it was a trauma. One example I'll give you, we had to take over a hotel at one point. All right. So, REO, we foreclosed on this hotel. And as we approached the auction, suddenly dawned on us, we were going to have to serve coffee and muffins and cheese that day, oh my goodness. So how do we deal with that? So it was kind of cool, actually. It's a long story, but I found a company that's what they literally dropped a bunch of people in there, kicked everybody else out, took over and ran the thing until we could sell it as an REO. But until you realize actually what it means to take these things over, it's a big deal. Let me ask you, let's wrap up. We should start wrapping up, actually, because we've gone for a while and we should definitely revisit in a few months. And I would love to do that, Sean. What is the biggest challenge that you're facing at the moment? What are you dealing with?
Yeah, always. So for us, on the asset side, we've been at it 8 years. We're a name brand in the market. Originations is not a problem. We actually don't have a single originator on staff. So the vast majority of our business comes to the door. And that's very unusual for lenders, right? We've built up a brand name for ourselves kind of by focusing on a certain clientele and doing a really good job. Asset managing, always, look, if you have to take over a loan, like you described, it's always a pain in the ass. There's tons of legal work. There's stuff like that. But we've done it. We've got a formula for it. It's part of our business. The part of the business that's always a challenge for me, and this is it's not my background. It's easy for some, but hard for me, is the capital raising side. That's something, we had this conversation.
Yeah. And your target, who's your ideal capital provider?
High net worth investors, individual accredited to, high net worth and family office investors, right? Groups that get it, that want, need to be in this or want to be in this kind of protected position going through it and understand what it is.
A minimum investment?
50,000.
Right. Let me wrap up with some rapid fire questions. Try and do rapid fire answers if you can. I'm going to do rapid fire questions.
All right.
2 or 3. Are there any market signals that you're watching that will give you an early warning of any shifts in the industry or in the market? What do you watch?
Watch inventory like a hawk.
Inventory being what exactly?
Housing inventory. So how many units, how many months supply are on the market? So, when you see month supply start spiking, and it could be different for every single market, right? How many months, how many units are unsold in your market of any particular type? That gives you a leading indicator that prices are coming down on the other side.
For those people who you've mentioned are sitting on cash because of uncertainty, apart from invest with RD advisors, what advice do you give or would you give to somebody sitting on cash at the moment? If you won $1 million, what would you do with it today?
First of all, don't have it all in one bank, especially as we talked about the tier 1 capital requirements. Maybe diversify into a couple different banks, right? Then ask yourself a question: how long do you want to sit on it for, right? What are you waiting for, right, before you deploy it? I personally am, kind of a little bit worried about the stock market. That's my own personal view. Some people have views, and I've just said, hey, you know what? I don't like the volatility, right? I've tried to go into, a yielding position, right? And so that's why we have our own fund. I think on the, buying assets, unless it's a screaming good deal, I think you're going to have better deals, in the future. So, one, diversify banks if you're holding cash. Two, diversify into different positions. Three, I think we're going to, prepare for some turbulence in the market and look forward and say, what is going to happen to this capital? Will I need it a year from now? What is it I really want to get? And then don't throw it into the stock market, find the stock market collapses 30% and think that's where you're going to get your capital to then buy acquisitions, because your market you just lost your capital, right? So be cognizant of that diversification and where you're putting your capital.
Oh my goodness. Honestly, it's such a relief to talk to you. Seriously. I mean, most people that I speak to just seem to be chugging along as though everything's just wonderful. It's like blows my mind.
It is until it isn't, right? And that's the thing is everybody says, well, it's just normal. You know what? When we were on the eve of Lehman's, bankruptcy, right? When things, wasn't right before. But I remember sitting in the London office. The US started blowing up. And people in Europe were going, well, this is great. This is absolute grand for us. The US is collapsing over there. Can't happen here. You know what? The fact that everything's blowing up there will be more inflow to our market of capital. This is just great for our market. Mm-hmm. Well, we're kind of all interconnected. It's not. And I think the same thing on the housing values. One of the things I find most interesting is not reading the news, but Googling the news on the eve of, go back and read the news in 2008. Go back and look up the housing section of the New York Times or the Wall Street Journal from January 2008. And you'll find some articles. And I remember reading an article about a person wanting to buy a home and standing in line to get into an open house for a condo and the price going above. And you're like, this is in 2008. This isn't 06. This is 08. Open houses were still packed. In hindsight, everybody goes back and go, oh, we all knew the world was collapsing. We all knew back in 06 that this was unsustainable. Yeah, well, a lot of people were lining up at an open house, desperate to buy a house or a condo in New York City on the eve of, global financial crisis. Well, are we smarter today, or is it just different signals that we're missing? And what is the signal today that when we go back and read the news in 2035, that we're going to look and go, oh man. And there's going to be things that I completely miss. You're in hindsight, you're going to be like, oh, that was so obvious. But it wasn't obvious at the moment, right?
Sean Kelly-Rand, seriously, we're going to finish on that point. That is exactly my perspective on what's going on. To me, I just think we are living through a black swan event right now. It doesn't seem like, well, how can anyone see anything different right now? It just, it's mind-boggling.
We'll see it. We'll record it. We'll put this out. We'll have a posterity, and we'll go back and we'll be like, look, see, we recorded this.
We said it, and we
2025 in May. Here's what we said. Look what
That's
happened.
right.
And if we're completely wrong, and the bull market runs up for anher 10 years or 5 years, done there, we'll hide it. We'll hide it.
Yeah, exactly. We won't share it with anybody.
We'll keep recording it every year, and then we can say, well, in 2030 we said, and then 2031 it collapses. I knew I was right because we recorded it every year.
Sean Kelly-Rand, Managing Partner, RD Advisors. What an enormous pleasure to have met you, and thank you so much for having joined me today.
Perfect. Thank you very much. Awesome being on here. Loved it.
All right, that was my friend Sean Kelly-Rand at RD Advisors. What an fascinating conversation, Sean. Such a pleasure to be able to get into this stuff with you at depth or in depth. I've enjoyed our back and forths on LinkedIn, of course, but particularly nice to be able to share or to hear your story and your insights in this conversation. Thank you so much for spending your time with me today. And thank you, dear listeners and viewers, also for listening in. I'm sure that you learned something, right? If you have not, particularly if you've not been through a downturn like Sean and I have, it's definitely worth tapping into and understanding the perspective of those who have. So thanks so much for joining us today on the podcast. Again, if you've not already done so, please go to garrowcrowd.com and subscribe to my newsletter, where I will be publishing these podcasts with detailed analysis in written formats as well as the audio as soon as they come out at gowercrowd.com. So just go to gowercrowd.com, click the subscribe button. And if you want to contact me, as soon as you get one of those newsletters, you could just hit reply. It comes directly to me, and I would be more than happy to field any questions that you have. Okay, that's it for today's episode. And until next time, this is Adam Gower signing off.